And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow.
Hello, everyone. Welcome to another School for Startups Radio Market Update. My name is Jim Beach, and I'm welcomed, as always, by our good friend Dale Gillham. He is with wealthwithin.us, and author of the fantastic book, Accelerate Your Wealth. It's your money, your choice. Our ongoing series teaching us all about the market. Dale, big day today. The market closed with a new high. What do you think?
Look, mate, I think it's been really, really good. I mean, it was up, it was up quite nicely today, and we've seen that the Dow's up nearly 4% for November, so that's quite a nice run, actually, and I think, we're over 28,000 points. I think closed somewhere around about 28,066. So I think it is heading for that 30,000, but one thing that still really worries me, we really haven't had that yearly low that I was expecting, that pullback, it wasn't enough in my book. So that always lingers in the back of my mind. It's always one of those things when you're doing something and think what could happen. So it still won't surprise me if the market just moves up for a little bit and then falls away into a yearly low. But right now, I think overall it's bullish. It's looking good.
I read an interesting report yesterday that one of the large hedge firms has taken a multi-billion-dollar short on the entire market. So I have a feeling that a lot of us feel like we're due for something big negative. Does that make sense?
Yeah, it does, and it really does make sense. It's often the market is a contrarian view. You need to take that kind of view, and often when you hear the best news out there, that's the time to start getting really nervous and exiting, and often when you hear the worst news out there, it's time to get going. But you don't really know. I take a lot of that sort of news not quite with a grain of salt. You do need to take notice of it, but not much, because they could be just looking for the yearly low that I'm talking about, which could be, 4, 5, 6% drop. And with that kind of money, you're going to make a hell of a lot of money pretty quickly if it does drop quite fast like I was expecting it to over a short period of time. And that's how those big funds work. They have people sitting in there, prop traders. They sit on their desks and all they do is they trade all day, and they're just putting millions or tens of millions or hundreds of millions of dollars on a trade trying to make 1 or 2%, and people think that's real trading. Well, it's not. I've met a few prop traders in my life, and they know very little about the stock market. They have a very defined sort of set of rules that they're allowed to work on, and that's how they work, on very small margins of trying to get moves of 1 or 2%. So that's all that could be happening right there.
Well, even if the market were to fall back 4 or 5%, it would still be up 15 for the year, right? So a 4 or 5% loss sounds catastrophic until you look at the larger picture. It wouldn't really be that bad. Would 4 or 5% satisfy you that we've hit the market low?
I was expecting more like 6 to 8%, but 4 to 5%. The more it comes down a little bit right now, the better it is to springboard up. And I think I've mentioned it in the past. It's sort of when you walk upstairs, you have to put your foot down to get leverage to move up. In the stock market, we've got to see where the balance is between the buyers and sellers. We need to see how strong the buyers are and how strong the sellers are. So if the down moves are more, that means there's more sellers. If the up moves are more, that means there's more buyers. And that's quite a generalized explanation of it, or a very high level generalized explanation of it. But you get the idea. It's just about testing buyers and sellers, or supply demand. Probably an easy way of explaining it to you. There's more demand, price goes up, more supply, price goes down. And that's really what we need to measure. And we haven't been able to measure that for the last couple of months, really, because it hasn't been falling away, but it hasn't really been rising. But now the demand seems to be there and it's rising. It looks good.
So today is Monday the 25th as we record this. The rest of the week I'm taking off. I feel like everyone I know is taking the week off, Dale. What does that mean for the market? Fewer buyers and fewer sellers, and so things are hard to predict, aren't they? What do you think?
Yeah, you tend to find these sorts of periods where you get holidays, like a sustained holiday, and I know this type of year in the year, or this time of year in the US, people have big long weekends. You know, they have at least 4 days off. Some people take a whole week off, and you're taking almost a whole week off from that point of view. So you do get lower volumes coming through the markets. Christmas is another period, that sort of between Christmas and New Year's, that sort of 4 to 5, 6 days there that the market is trading tends to be very, very low volumes, and it tends to slowly start picking up, you know, the second week of January. So you always see, and I know traders and investors get really worried. They go, wow, there's no volume on the market. That's pretty normal. So you're not going to get such a volatile moves in the market, and it can be a great opportunity to get some nice stocks while everybody else is looking everywhere at their, you know, at what's going on, and the what do they call it, the Black Friday sales and everything else that's going on. While they're looking the other way, you could get some nice bargains.
Yeah, the Black Friday sales have already started. It seems like it's the Black Week sales now here in the United States. So we've already been inundated with bargains. And Dale, I'll give you a secret. I'm already done with my Christmas shopping. So I'm
Fantastic.
excited. Yes. All right. Let's move on. One of the things that we hear is to buy and hold. That the good strategy is to ride the market out, ride the downs and the upturns, and keep investing every month. Put your $100, your $200 in, and buy and hold, buy and hold. Educate us, Dale. Is this a good strategy?
Well, you do make money out of that, but you don't really make good returns in my book, because good returns are relative. But I know, you know, with investors, with research, they say investors want guaranteed returns, and number two, they want returns of around 8%. So we're told that by the industry, just to be patient and invest for the long term, 10 years or more, and you'll get one of those really, really good returns. But is it a case that the financial industry is talking us up, saying, well, let's expect 8%? Well, I think we should expect more, because as you said, even if the Dow falls away, it's still going to do at least 15% for the year. And looking at research, people are making better returns than 8% if they're more active, like I talk about in my book. But buy and hold, you do make average returns over a 10-year period. But I'll give you a bit of an example. If you'd simply bought and hold the stocks on the Dow Jones over the 10-year period, ending December 2016, this is stuff I talk about in my book, your return would have been 7.5 plus 3%, including dividends. And if you'd adopted a buy and hold strategy over 20 years to December 2017, your compounded return would have been 8.34. So you would have been getting what they call average returns, including those. So therefore, you could say I'm getting a good return, but in my book, I'm teaching people to make a hell of a lot more, and they should be expecting more if they're just a little bit more active, because the industry is really trying to, shape our expectations of what we can expect. So they don't like to see us, they don't like to pay us a lot of money or get us a big return, because then we expect that every year. So they make they make us expect lower returns. So when we get a better one, we go, wow, you know. And I think that's really what it's about. But if we delve, you know, really deeper into the Dow Jones, we know it's had 3 bull runs in the last 20 years, you know, and we're currently, the largest bull run was up into the GFC high in 2007. But right now, we've been in a bull run since March 2009, and it's still not finished. So we've been going over 10 years. So it's got to finish somewhere. But as I mentioned in my book, I just some really, really simple rules trading the stocks on the Dow Jones. So that was the 30 stocks on the Dow Jones to the 10 years to December 2016, where a buy and hold achieved on the Dow 7 point something percent from memory, or whatever I just said before. But if you use some basic active rules like stop losses, what we talk about, trend lines like I talk about, your average compounded rate of return would have been 18.59%. So you more than doubled it just by being a little bit more active on the same stocks. So, and you do it at lower risk.
The numbers are amazing and so impressive, Dale. So again, just so everyone understands, if they didn't see our other videos, one of the main tenets of your strategy, this 18.5% strategy, hold the top 10 stocks of the year, the top Dow members by market cap, and reevaluate that every year. Is that getting close to describing the 18.5%?
Well, it is.
Method?
You'd get better than the 7.5 or 8% doing that. Absolutely, you'd get better than that, than a buy and hold, because that's being more active. What I'm talking about is being slightly more active again. I know we've talked a bit about stop losses over the time
Yes.
we've been chatting about. So enacting stop losses to protect the drop, because if you have a stock that drops 50% on you, your remaining capital has to rise 100% to break even. But if we can minimise the loss or that drop and get into another stock, then that capital has more chance of growing and compounding for us. So by doing that, and that's why I talked about a few weeks about, if you can afford to have a ruler and a pencil, that's all you're going to need. And really, everything in my book you can use a ruler and a pencil to do, and you don't need to have an economics degree or a finance degree or even any degree to be able to do it. It's quite simple. Just draw a few lines, have a stop loss, and you'll make that 18%.
I love it. Let's switch topics again. One of the things that you and I have enjoyed bantering about and disagreeing on is our friend Elon Musk and Tesla. Did you see their new creation? I'm not going to call it a car because it's supposedly a light truck or whatever. It's the ugliest thing on earth. And secondly, they broke the windows during the demo. And so they're saying that it was a good thing the windows broke because of all the free PR. Here you and I are talking about them. 200,000 orders so far. Dale, I still don't believe it. It's still a junk stock. It's never going to be the winner. I'm sorry. What do you think of their new thing?
You're allowed to be wrong, mate. That's no problems at all. No, I think the car's terrible as well. It's the ugliest thing I've ever seen, and I'd never have one, but... hey, if it's a good marketing stunt, it's a good marketing stunt. But last week, Tesla was down, I think, 4.5%. So it was a week for you in terms of that. But you're looking at it more from a fundamental perspective, and that's really where. But I'm looking at it much more from a technical perspective, because what happens is fundamentals tend to lag the actual technicals. Technicals lead. And so what I mean by that is they show us what's actually happening on the stock. What's the buying and selling happening? Or that supply and demand that I talked about a few minutes ago. And all that's telling me with a whole lot of technical analysis is that Tesla's finished falling away and it's rising up. And eventually the good news comes out, because what actually happens with markets and stocks is you get bad news, bad news, bad news, bad news, bad news, bad news, and then there's not much news, and then it starts going, good news, good news, good news. So right now we're finishing off the bad news and getting into the not much news, and then eventually you'll start getting good news.
And so Tesla is a buy for you right now?
I think it's a great stock at the moment, and yeah, I'd be looking at buying it for people's portfolios because it does look really, really good. Not that I like the look of that truck thing, but
yeah.
But
I was surprised that the same group of designers who designed the beautiful other Teslas came out with that. Maybe they were told to make it ugly. I don't know. What other issues do we need to worry about? I'm sorry, go ahead. I missed that.
I was saying maybe they were smoking something when they designed it.
Well, yes, that was not smart of him to say that either. All right. Dale, what else do we need to talk about on this slow Thanksgiving week? What else do you see?
Oh, there's some good economics figures out at the moment. We've got the composite index is at 4 months high. The service businesses activity index is up 4 months high. Manufacturing PMI is at 7 months high. The manufacturing output index is at 10 months high. So from a point of view of output of manufacturing, things are looking a little bit there. And the retail sector, moving ahead into Christmas, it's a little bit of a tale of two cities, I suppose, if you're looking at it. About last week, about half the retail stocks were up, half were about down a little bit. Target was up 12% last week after reporting a 10% dividend growth in their apparel earnings, and that was excellent. And but as I said, roughly about half of the other retailers are down. Home Depot, which has been very bullish of late, was down about 8%, as was Macy, and Coles was down 20.45% after a profit or announcing poor results. But I think after seeing the results from last week with consumer spending and everything up, I think we're going to get a good Christmas. But I will be looking at that mixed bag for figures for November, figures and December figures for looking at some sort of direction for next year in retail. But I'm expecting it might be a little bit better than what we might be thinking, those retail figures. So let's cross our fingers and hope we get a China trade deal soon.
Well, we've been hoping that for a long time. You know, I always consider myself a bellwether of everyone else. I feel like I'm the generic American and that I represent everyone else. I think it's interesting that I've already done my Christmas shopping. That means that I will buy more and probably blow through my budget. I have a feeling that a lot of people are going to buy a little bit more than they anticipated. I'm predicting a strong up Christmas, maybe even up 3 or 4% over last year, or something fairly significant. What do you think?
Look, I don't discount that, because people have, for the last 10 years, there's been a lot of doom and gloom around the economy. There's been a lot of things to not be happy about, and times change. People get sick and tired of being sick and tired, and people get sick and tired of worrying about their jobs or worrying about other things. And so by having a good Christmas and that cheer with having family around and buying presents, that really does create a nice positive atmosphere. And eventually, if you'd had a few lean Christmases, you want to get out and splash out. And I think that's what I'm thinking, is we're now moving into a new decade. You know, next year is 2020, so we're moving into a new decade. I think we're ending off things this year, and we're going to go very, very nicely over the coming 12 months to a couple of years. So I'm with you, mate. I think the market's up. I think it's going to go towards 30,000 over the next few months, and I think it's going to be a really nice Christmas.
Well, I hope so. And I hope you have a fantastic week as we all celebrate Thanksgiving, and look forward to talking to you next week when we have the Black Friday numbers already in and we can talk about that. Again, Dale Gillham, wealthwithin.us, and the book Accelerate Your Wealth. It's your money, your choice. Dale, thank you so much for being with us again, and we will talk to you next week, my friend.
Thanks, Jim.
And we will be back next week. Take care.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Again, it was another interesting week on the US markets. We've seen that the Dow down a little bit. There was a little bit of nervousness during the week. And it's interesting when you see that. You see the Dow and the S&P fall heavily for a couple of days. You see all the headlines coming out with all this doom and gloom. And it's like, it just drives me crazy as a fund manager and trader myself. It's like, well, 2 days doesn't make a portfolio. Not even 1 day makes a portfolio. And, you know, you don't put all your wealth onto a couple of days of what's going down, and journalists tend to over sensationalize it. But you saw on Friday the Dow just came right back again. But let's have a look at the chart and actually see what did happen last week. Now on the screen you've got a monthly chart at this point in time, which is the one I shared with you last week, and you can see here it's broken above that line that we talked about to close higher. So it did all right at this point in time. But let's go and now look at the weekly chart and see what happened. So you can see here this was last week, which is to last Friday. So it opened and pushed right down and then came right back, and it's still above that line. So that's interesting. If I go down to our daily view, which is what I suggest you don't actually do and look at stocks, but you can see this big move down. It actually moved up from the Monday. So Monday it moved up a little bit. Tuesday it opened and then traded down. And we at one stage here, from that move, there's like a 1.4% move. So a couple of days it was down. Then we had there, so that was Wednesday, Thursday, Friday, it picked back up again, and it was back above that line again. So what were they all worried about? And the thing is, it's never about 1 day or 2 days on the market, as I was saying. It's very, very much about the bigger picture, and that's why we always go and look at that monthly chart. So let's have a look at the monthly chart again, because while you're looking at that monthly chart, that looks bullish, doesn't it? It's look a bit funny here compared to what it's done all the way through here. It normally comes down, nice little even move down, then takes off. And we had that big move down into December last year, that nice move down. I was expecting a bigger move down so we can get, like a nice move and nice steady moves It's just been sort of rising, which is what is causing a little bit of concern with a whole lot of analysts. It's not really pushing through, but it did make a new all-time high this month, or has made a new all-time high this month. It is still looking bullish. I still think it looks good, but we haven't really had a yearly low on this market. So that's the only thing in the back of my mind, that it needs to have a yearly low, which may come in over the next 1 or 2 months. We may see that, we may not. It may keep going, but as always, keep stop losses on your stocks, and that's really what I keep saying to you. You need to keep stop losses on your stocks, because it does not matter what you do. I was having an argument with an analyst, or a discussion, I suppose it's probably a better way of saying it, with an analyst only last week, and they say, but what the Dow's doing this, or the Dow's doing that, and blah blah blah, and what are you going to do with this and this and this? And I said, I don't really care what the Dow does, and I'm serious. I don't care what the Dow or the S&P does. It's irrelevant, because all I can do is trade stocks. So what the Dow and the S&P does is irrelevant, because there's always going to be stocks in both of those index that are going to go up while the index is going down, and there's going to be stocks going down while the index is going up. My job is just to get out of stocks that are going down and get into stocks going up. Keep it simple. But too many people worry about what the overall market is going to do to make their investing decisions. So there are people jumping out of their portfolios and jumping out of stocks and moving into cash or gold or other things because they're worried about the market. But when just having a simple stop loss on your stocks will protect your portfolio, and then it also allow you to stay in stocks that are rising, so you get those returns and get out of stocks that start to fall away. It looks pretty simple, doesn't it, to me? But let's get into our questions for this week from our people over there, and from you, from anybody in the US. So let's have a look at those right now. Now, I've also got some stocks that I want to have a look at from my reports. So some of the great stocks for this week and some of the poorer stocks for this week, just to have a little bit of a look at it, because I often find people jump into stocks because they've had a lift, or they jump into them when they have a heavy fall thinking, hey, I can pick up a real bargain. But I do have a question this week from Gary, and I'll grab my little thing. This is Gary Hornet, says, hi Dale, new to the site. Welcome Gary, glad to see you on the site. He says, what's your take on other video hosts like George Gammon talking about 2020 recession being worse than 2009 because of the global debt and derivatives, etc. He says, thanks, retire in 5 months and worried. He said, I retire in 5 months and worried. I invest equity wise in low beta, average dividend paying stocks, 3 to 6% yield, mostly hold bond funds and gold, silver and bullion. So that's really interesting, and I'd never heard of this person before, and I'm sure he's never heard of me before, but that's okay. It's good to get information, but it's also good to pull that apart as well. And to me, right now is completely different than what things were back in 2007. 2009 was the low. We had March 2009 low. The issues were happening prior to 2007, or the 2007 high, where there was over leveraging. The whole GFC was caused with over leveraging. So that's over borrowing money, and I don't see that at this point in time. There's not a lot of, we're not over borrowing. Yes, the economy is not great, but they're showing some signs that it is. So there's some good signals, like we talked about in the report with Jim. So I'm not really worried about a recession, because even in some, like the Great Depression, the 29 depression, the market crashed in 29, but the market low happened in 1932, and from there, during the Great Recession, the market rose hundreds of percent over the couple of years. So even in recessions, market rises, and even in economic downturns, the stocks will rise. We need to keep that in mind, is there's always stocks that are rising, because what stocks are going to benefit during those times and what aren't going to be benefiting during those times. That's my role as a fund manager, and it's my role as a trader, just to find stocks that are going up. So I think looking at the bigger picture is great, because you might think, well, okay, the market's not going to run as fast as it could, but I'll still be able to find stocks in there. And as long as you use a stop loss, follow the rules in my book, Accelerate Your Wealth, you'll make money in recessions, boom times, bears, bust, you name it, crashes. You'll completely avoid crashes if you follow the rules in my book. But really, really good questions. So, and thank you for watching. But if you, have more questions, please stick them down below. I'm happy to answer them. Next one we got's from a lady called Maria. She says, thank you, Dale. I'm pretty new to all this, but I'm really starting to understand your reports now, and you have a great way about you when you explain things. So thanks very much. I do try and keep it very, very simple for people. I find you get experts that make things very, really complicated so that you use them. I'd rather empower you so that you can make more money in the market. And if you choose to buy my books or you choose to take on some of my courses and our mentoring services, that's great. If you don't and you learn something and you make more money, that's fantastic too. But I'd rather keep it nice and simple for you so that you understand what I'm talking about, because investing in the market is not hard. It's really easy and it's really simple. You just need some rules around you. That's all it is. And you can, and I'll say that again, you can beat all the managed funds. All the managed funds, like all those index funds, you'll beat them, and you'll beat the majority of fund managers throughout the US if you take an active approach. That's what I'm really keen on having people do, and by reading my book you'll understand why I talk about that and how you can take control of your future and do better for yourself. But let's go and have a look at some stocks now. Now I did bring up some stocks like Netflix. So that Netflix, as you saw in my report, was one of the bigger earners, and I do like Netflix. I do like Disney as well. It's another good performer last week. Disney's been going up for a little while, and I know there's like this whole war between Netflix and Disney, or with these streaming services, Apple streaming services with Apple Plus now. There's a whole lot of conjecture around that whole area, but I actually do like Netflix. Netflix has fallen away because of all of that, Disney announcing coming into the streaming, back there. So that's from June 2018, fell away, but it's looking a lot better now. And so you can see here over now's the time to get into Netflix right now. And that's really, it's not looking very, very nice. It's a good stock. So I do really, really like it. And last week's jump was a big jump on good news, but it doesn't mean it's getting too late to get into it. Let's go and have a look at Amon. It was Amgen. Sorry, I misread that. I don't have my glasses on today, guys. It's now made a new all-time high. You can see that it's just broken up in a beautiful trend. It's probably gone a little bit hard at this point in time. We can see 1, 2, 3, 4, 5, 6, 7 weeks up. I'd suggest it's going to come back down over the next few weeks and just ease a little bit. So it's probably a bit too far to get into it at this point in time, but it does look bullish. But if it does come back down and comes back down to sort of this sort of 210 to 220 area and then find some support to move up again, then I'd suggest this could also be a nice little buy, but it is looking good. Now we're going to Schlumberger. Schlumberger was one of the ones that's been hit really hard over the past few years, and I have talked about this stock a few times, and I talked about it a few months ago about possibly being the dark horse in the S&P 500 in terms of what it could possibly do. And you can see here, July 2014, it was $118. If I use my cool little tool here, you can see here how it fell right down here, 74.19%, or nearly 75%. But you can see here, if I look at that, it's starting to look a lot better. And if you look over here, it's looking much, much better. So if this thing keeps moving up over this next week, I think there could be some good opportunities for you to possibly pick this stock up quite nice and early and get some of the rise sort of back from where it is. Look at that, just back up to that high there. There's 30-odd%. So it could be a nice little buy for somebody. But remember, always have your stop losses in, because it's not super confirmed now that it's stopped falling, but it's starting to rise. So if it's not fully confirmed that it stopped falling, it means you need to have a stop loss underneath it. If you don't intend having a stop loss on this stock right now and you look to go into it, then you're gambling, and I'd suggest you don't do it. So make sure you set your stop loss first, then jump into it. So let's look at the next one, Nvidia. Now, probably if you've been watching this for quite a while, you'll know that I've liked a lot of these semiconductor area, like Qualcomm, Nvidia, Intel. I do like those stocks, and I have liked them for quite some time. And you can see here why I've liked Nvidia. It's just beautifully looking really, really, really nice. And it's been moving up since December last year. It'll be interesting to see if it comes down into another little low over the next month or so. But more medium to longer term, I do like these stocks, just the same as I still like Intel and Qualcomm and some of the others there. Let's look now at a couple of the Qualcomm I'm bringing up. So there's Qualcomm here. Again, you can see this is one of the worst stocks in the top 100 stocks in the S&P last week, because it had this big move down. But to me, it's just coming back down to this sort of area. If it turns around over the next week or so, then I'd suggest it's going to be good, and it's going to move right through that all-time high that it's had back here. You can see that's the all-time high back there. I've misplaced that back up at $100. I think it'll give it a shot. If you get, as I said, if you get some like an inside move here and are starting to move up over the next week, I think it'll blow through that high and then do well. If it does keep going down, it might just be filling that little gap there, find some support and move up. But just watch this one at this point in time. Last one I wanted to talk about is Home Depot, which also had a bad run last week. You can see the huge big move, but look at it, it's bullish. Looks great, and the retail stocks a little bit 50-50 as I mentioned in my report at the moment. Some retail stocks are doing really well, like Target did last week, but then we've got some that did the opposite, and some are looking a little bit more bearish. This is a bullish stock. It's just had a bad report, so let's see what it comes down to, but it's probably just coming back down to its angle of that move at this point in time, but it still looks all right to me, but we'll see how far it falls this week. If it stops falling pretty soon and starts to move up, it could be a nice little buy at a slightly cheaper price. So that's it for me for the questions for this week. So thank you for those people that did send your questions in. When you send a question, I'd love to know where you are in the US. If you tell me where you are, because that's exciting to me to know who's listening. We had a gentleman from Sweden saying he was watching our videos last week. So tell me where you are when you put your questions on. But thanks for sending in those questions, and thanks for watching until the end of the video and listening to this Aussie guy. Now, if you have any questions you'd like me to answer for you, just stick them below. So get your fingers on the keyboard and start typing. Remember, I do these reports every week, so hit the subscribe button now and click the bell on the right of it so you know when we do go live and update with our latest reports. But for now, I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.